I learned the ICT concepts relatively quickly. It took me about 2 to 3 months, but I went all in. I'm talking 8 to 10 hours a day, 7 days a week of deep studying, focused back testing, and no distractions. I was fortunate enough to get guidance directly from ICT himself from his YouTube channel, as well as others who have truly mastered this craft. Now you're probably wondering how I learned ICT in 3 months, and more importantly, how I've stayed profitable ever since I finally got it to click. So my trading journey was, I've been trading on and off for about 5 years, I want to say. I started with an offshore broker offering 1 to 500 leverage, and that account got smoked. Then I caught a lucky $7,000 Bitcoin trade back in the MetaTrader days. I took a break and I later dove into options trading on Robinhood, and I made some solid money, but it was a completely different style of trading. Since 2024, I've been locked into the prop firm space. My full focus is here until I've built enough capital to go heavy on my personal accounts. So here's what I learned the hard way. The goal is to eventually trade your own capital with zero restrictions, but for now, in the prop firm space, we have to play by their rules. Now, there's a set of rules that I personally have that actually work, and I'm going to give them to you for free because I paid the price to learn them. I used to trade RSI, VWAP, EMA crossovers, you name it, but it never gave me real structure. I needed a rule-based model that aligned with how smart money actually moves. That's when I found ICT and everything changed. At first, it felt like shiny object syndrome, but I stuck with it and I studied for hours. I took detailed notes and rewatched every piece until one day something clicked. Now, if you're not consistently profitable, you have to choose a prop firm that offers you end of day drawdown. That means your drawdown only updates after the day closes, and that's giving you more breathing room to grow a buffer and protect your profits. Now let's dive into step 1, risk parameters and trade limits. So once you've gotten your account, you want to risk preferably 10% of your total drawdown per trade. So for example, if your drawdown is $10,000, you want to risk $1,000 max per trade. In the evaluation phase, limit yourself to 2 trades per session. So there's a couple sessions, right? I count the New York AM and New York PM session as separate sessions, and I also trade sometimes the London session personally. I don't touch the Asia session because it's a little bit too slow for me. If you take 2 to 3 losses in a row, you shut it down for the day. You're here to pass and you're not here to tilt. So why be a little aggressive in the evaluation stage? That's because you're on a clock. Manage your risk properly though, so you don't end up constantly buying resets. Now fast forward into the funded phase. Me personally, once I'm funded, I only take 1 good trade per day. I have the same 10% rule for risk, but now patience is everything. Now you want to build your own model, right? Everybody's always wondering, how do you build a model? Let's talk about it. It's the engine behind your consistent profitability. So to build your own model, you need to understand what the market is doing. Now, the market is doing one of 2 things always. It's either moving internal range liquidity or external range liquidity. So what's internal range liquidity? I like to think of it as fair value gaps, order blocks, etc., right? Those PD arrays. Now, external range liquidity is stop losses. Now, those stop losses that are outside of your whole dealing range, that's your external range liquidity. I have a couple questions I ask myself before I enter a trade. And now it's already become something that's second nature, and I know it like the back of my hand. So the questions that I ask myself personally is, where's the draw on liquidity? What are my points of interest? Has the draw on liquidity been met? Is there a liquidity sweep, a fair value gap, an order block, a breaker block, or an inverse fair value gap? Is there a market structure shift, a change in the state of delivery? Has the hourly candle been closed? Is the session liquidity swept? I look for all of these things, right? And I don't enter a trade unless some of these boxes are checked. Most ICT traders fail not because the ICT concepts don't work, but it's because they try to trade everything together. And that causes analysis paralysis and it kills your execution. So let's break it down a little bit and start simple. I currently have nothing marked on my chart except for 930, the 830, and the previous daily levels, alongside with the previous weekly and the monthly with the true day open. So if I was to frame a trade here, I would personally look at what are my draws on liquidity. This is just in hindsight. I've already traded this session. I made money. I'm just kind of recapping my trade. So now I'm going to mark the highs and lows that are very obvious to me, right? So I see this, and here's my buy side liquidity. And now I'll see this. Here's my sell side liquidity. Usually I have ES paired on the side as well for SMT divergence. I'll dive into that later. So now I want to establish imbalances. What's one obvious imbalance I could see? This fair value gap. Now, why do I choose this one? Because it's the first fair value gap in my premium and discount. Now, I want to see liquidity being swept before I ever enter a trade. So here, for instance, we get liquidity being swept. That alone gives me the basis to potentially look for a trade. Ultimately, this is all in hindsight and it's a lower time frame. I'm just showing you this as an example, but you're going to want to look for these things in a higher time frame before going down into your lower. Now, to keep things simple, I see both buy side and sell side have been swept. However, my overall internal range liquidity has not been met. So now I'll be looking for PD arrays after a market structure shift. So here I can see a market structure shift, and now I see my fair value gap, and I can frame a trade based off of this. Normally you want to target a 1 to 2, but in this instance I'm using a breaker as my stop loss, and I'm going to be targeting a 1 to 3. So here we get tagged in and we get a little bit of drawdown going, but you can overall see that the trade now starts to flow in our direction. Now fast forward a little bit and we tag right into that 1 to 3, which nets us 90 points. Again, this is all in hindsight. I just kind of wanted to show you what I'm looking at whenever I say sweep of buy side liquidity or sell side liquidity. So again, back to what I said, the market's always doing one of two things, whether that's moving external or back to internal. So from here, you can kind of frame your longs. So now you see that buy side liquidity has now been swept again after tagging into internal range liquidity. The market constantly does one of these two things, and your job is to find out how to trade with that one thing that is currently doing. So we've already established that once price taps a key liquidity level, it's time to pay attention. Now I want to talk to you guys about premium and discount logic. So that's a dealing range, and I kind of get my Gannon Fib box and I mark it from the high and the low, the very obvious high to the very obvious low. And that is now my dealing range. In this area, I'm only looking to short in a premium and long in a discount. Don't break that rule. That is the most important thing that you need to do. Now let's keep it to 3 core variables: premium, discount, fair value gap, and liquidity sweep. This is all you need for a decent and clean trading model. If you prefer visual clarity, start with fair value gaps and build from there as your eye sharpens. So now when it comes to time frames and execution, I personally like to execute my trades on the 1 minute, the 3 minute, or the 5 minute. And I like to have my 15 minute, the 1 hour, and the 4 hour for context. This gives me a higher time frame understanding of what the market's doing and what is likely to do. And hopping on a lower time frame is where I like to potentially frame my entry. So when it comes to stop losses and take profits, you want to keep it structured. There's no second guessing mid trade. So again, when we go back to our premium discount and our fair value gaps alongside with the liquidity sweeps, what can we also pair this with to give us a proper take profit and a stop loss? Me personally, I like to use protected swings unless my risk is too much. Then at that point, I'll be looking to use the breaker. But there's many different ways people place their stop losses. Some people place their stop losses at the end of a fair value gap, where in this case, you would have gotten taken out. Some people place their stop losses above the bar that creates the fair value gap. In this case, you live. Some people place them above the breaker, which again, in this case, you live. And some people place them above the swing. Now, you have to look at your risk to reward and where your draw is in order to determine a fair risk to reward. And ultimately, it comes down to your win rate and your profit target. If your profit target aim is 1 to 2, a 50% win rate will make you profitable. If it's a 1 to 3, a 40% win rate will make you profitable, and so on. I like to personally stick to a 1 to 2 because I'm usually above a 60 to 70% win rate. At times I'll get my 1 to 3, and sometimes I'll even get my 1 to 5, but usually most of my trades end up at a 1 to 2 to a 1 to 3. Now here's one more thing that you could add to your arsenal as a really good weapon, and that's SMT divergence. So what is SMT divergence? I currently don't have a video on it, but I'll make one soon. But for now, SMT occurs when one correlated asset runs liquidity and another doesn't. That divergence equals hidden reverse potential. So you have to use SMT with structure and not alone. You can't frame a trade just off SMT. It needs to have some kind of confluence with the entirety of the context. Now let's break down a real chart example so you can see this in action. Everything that I just talked about paired with SMT could give you a decent enough trade. Now, why do I still think this SMT is valid? Because our draw on liquidity has not been met. So letting this trade finally play out, you see the SMT remains intact because NQ runs the high and ES doesn't. Now, at this point, it still doesn't get deleted and our draw on liquidity still has not been met. So in turn, our fair value gap entry is still valid and our draw is still this imbalance. Finally, our imbalance gets met, and now we head on over to potentially delete the SMT. There's plenty of PD arrays to choose from to build a model, but for now, I just kind of want to show you what you can do to create a beginner-friendly model. If you build a rule-based, liquidity-focused model with ICT principles, you'll stop gambling and you'll start executing your trades better. Stick to the model, stick to the rules, respect your drawdown, and take your one shot a day once you're funded. That's the only way that I suggest you trade. Moving on, in the future, you'll see more videos explaining how I use different PD arrays just to align them together with one. Thank you so much for watching, and if you like this content, be sure to leave a like and subscribe, and maybe a comment to share your thoughts. I do have a free Discord that anybody can just join and talk, and I recommend you do because a lot of us are usually talking mid-market. It's completely free, and I thank you guys for watching my video.